This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the return of the AJ Bell Money and Markets podcast after our summer break. Now we're kicking things off with our monthly special on investment trusts. My name is Dan Coatsworth and joining me is Laith Khalaf.
Hi Dan, how was your summer?
It was all right, thank you very much. Very good. Yeah, how about you?
Good, yeah. Pretty typical Bristol summer, so quite wet, quite blustery. But I've been missing our regular catch-up on investment trusts, so it's good to be back.
Yeah, so everyone listening to this, we've got some really good stuff on what's been happening over the summer, and we've got some really, really good interviews this week. So in a second, we're going to hear from Tom Sieber about how one trust has been battling some headwinds in its target market. Laith is going to talk to James Carthew from QuotedData about the big merger between Alliance Trust and Witan, which should complete in the next few months.
Yes, and lots of investors are increasingly turning to cheap tracker funds, which is putting pressure on investment trusts to not only outperform the market, but also to make their charges even more competitive. And to find out more about that topic, we'll be hearing from Annabel Brodie-Smith from the Association of Investment Companies.
The 3i Group continues to be one of the few investment trusts to trade at a chunky premium to the value of its underlying assets. So we thought it was worth chatting about what makes this investment trust special.
We'll also be talking to Paul Niven, who's manager of the popular F&C Investment Trust. He'll be telling us about the summer's market sell-off and how the trust has beaten the stock market over the past 10 years. First up, we're going to take a look at the latest results from one of the most popular trusts for investors to play the commodity space. BlackRock World Mining has just released its latest results, and there is some bad news, I'm afraid, for anyone thinking that metal producers are a great source of dividends. To tell us all, here is Shares Magazine editor Tom Sieber.
Hi, Laith. Yeah, thank you. So a casual observer might assume that metals and mining are a great place to be due to the energy transition, which is going to require lots of metals like copper, aluminium, nickel, lithium, you name it, and other minerals to increase the capacity of renewable energy and the volume of electric vehicles on our roads. However, as you say, the latest results from BlackRock World Mining, which also, as you said, is kind of the leading mining-focused investment trust, reveal a much more complex picture. So for a start, not all metals are created equal. And while we've seen the likes of gold and copper reach record highs in 2024, other metals have struggled. So looking at the results, the amount of revenue the trust derived from its underlying holdings, so essentially the dividends it got from its holdings, was down nearly 30% from the previous year. And that reflected a broader drop in dividends for the mining sector from what potentially represented something of a peak. So there's a few things playing into that. Miners have limited control over the price of the commoditized metals that they produce, at least in the short term. And that means that the returns they generate will fluctuate from year to year, and that obviously feeds through to dividends. And there'd also been quite a long period of discipline on the part of miners who'd avoided spending big on new mines or acquisitions and instead had ramped up their returns to shareholders. That's a dynamic that appears to be shifting a little bit, and we've already seen some signs of M&A stirring in the sector. And finally, while the energy transition is a big potential driver of demand, the timing and trajectory of it remain pretty uncertain. And in the short term, you've got the impact of what has been a fairly uneven recovery for China from COVID. And that's really affecting demand for metals like iron ore, which is used in steel production. And it's worth remembering China really matters here because it's a leading consumer of many global commodities. So to sum it up, I suppose, you're going to see inevitably periods of feast and famine for a trust like BlackRock World Mining. And in turn, that means the same for its shareholders.
Thanks, Tom. So we're potentially just a few months away from the completion of a merger between two of the market's best-known investment trusts, Alliance Trust and Witan. Now, given that a few listeners might own shares in one or both, we thought it was worth chatting about the merits of the deal with James Carthew from research group QuotedData. So Laith recently caught up with James, and here's what he had to say.
James, thank you for being with us today. We're talking about the Alliance Trust and Witan merger. Just to kick things off, can you maybe give us a quick overview of the key terms of the merger and precisely why it's happening?
It's pretty easy to do that in reverse order. So if we start off with why it's happening, Witan is a fund that's been around for 100 years now. Alliance Trust is even older than that. Both of them big global trusts, both of them really designed to serve the needs of ordinary investors. But one of them, Witan, has been underperforming the other by quite a big margin. And if we look at sort of 10-year numbers to the extent of that, Alliance Trust has returned about 200% over the last 10 years, and Witan, by contrast, has returned about 136%. So what Alliance has actually managed to beat the all-share index. So basically, it's done better than you would have done if you bought an ETF index or an index tracking fund. Witan has obviously been a long way behind that. So when we got to last a few months ago, Andrew Bell, who's the chief exec of Witan, decided to retire, and the board thought, well, what are we going to do? Are we going to try and replace him, find somebody else? Are we going to appoint somebody else? And so they basically announced that they were going to have a kind of beauty parade, and all sorts of proposals came in. But I think the one that stuck with them as making most sense was the idea of merging with Alliance. It just is the simplest thing for shareholders. It's going to be the least disruptive, but you should get better performance going forward if everything goes to plan, and a narrower discount, and you won't get a hit to your income. So those are the sort of key things. So in terms of trying to make that happen, it's a technical thing. It's a Section 110 scheme. So basically what that means is under the Companies Act, you can get Alliance Trust to take over Witan's assets, and Witan gets liquidated. You don't have to worry about the mechanics of that. But the reality is you exchange Witan shares for new Alliance shares, and the basis of the terms of that are determined by the NAVs of the two different trusts, so nobody loses out. Because there's a few unhappy Witan shareholders about given the performance, they've included a cash element to the transaction as part of this deal. So you can get out of up to 17.5% of the value of Witan as cash. So again, that's not 17.5% of your shareholding. It's slightly more complicated than that. But the reality is basically if you tick the cash box, to the extent that nobody else wants that cash, you might be able to get out of all of your holding. But if everybody ticks the cash box, then you won't get out more than 17.5%. That's the way it's kind of structured. That cash exit, though, is going to be at a 2.5% discount to NAV. So if you tick that cash box, you will get less than the value of the NAV. And that 2.5% covers quite a lot of the costs of the deal for ongoing shareholders. So they're kind of assuming that quite a lot of people are going to tick the cash box. They're going to get out slightly less than NAV. The benefit of them getting out slightly less than NAV goes to other Witan shareholders, and that helps cover the costs. On the Alliance Trust side, there's a contribution from the manager. So they are going to put in some money based on the amount of money that rolls over from Witan. But the numbers that they kind of worked out, that works at about sort of £7.5 million that the manager will put in, and that will cover Alliance Trust costs. So basically, as far as you're an Alliance Trust shareholder, nothing really changes. You just end up in a much bigger fund. But for Witan, you go across the Alliance Trust, and hopefully everything improves.
Okay, well, thank you for that. And I mean, the deal, as you say, is really borne by the fact that both of these are run in a sort of multi-manager type way, which perhaps you can explain to us. But for Witan shareholders, they're now getting the Alliance Trust strategy. So there's going to be a bit of a change for them. Can you maybe just run us through what the changes are, and just maybe are there any changes there in the investment strategy for the other set of shareholders, which is the people who currently hold Alliance Trust?
No, if you're an Alliance Trust shareholder, there won't really be any change at all. Obviously, there's a bigger pool of assets, But the sort of things that they're buying, it's not going to be a problem for them to buy more of them. So the managers will just start starting more money. There is a slight wrinkle in this, but I'll come back to that. But the way Alliance Trust is run, the Willis Towers Watson, who's the designated manager, their sort of speciality is in getting to know different investment managers and what makes them tick and how they work and who's good and who isn't. And that's what they do day in, day out. And they cover billions and billions and billions of pounds. So their job now for Alliance Trust is to go and pick 8 to 10 managers that they think are really good at doing their job. And each of them gets given the chance to run a 20 stock portfolio. So their 20 best ideas, normally on a global basis. So it's the best ideas that you've got to invest in the whole world. And the Willis Towers Watson are trying to blend them together so that not everybody's doing the same kind of job. So you've got some growth managers in there, some value managers in there, so kind of more market neutral type people. So you've got sort of blend of things. And the idea is that from a style point of view, it's style neutral. So you haven't got a big bias to small caps or large caps or anything like that. So you take that out of the equation. And then what drives the returns then is how good they are at picking stocks. And hopefully if Willis Towers Watson have done their job properly, they're all going to be quite good at that. And that's really worked for Alliance Trust. You've seen a big swing in markets over the last few years because of COVID and interest rates and inflation and everything else. So you had big swings from growth to value, and then you had the Magnificent Seven tech stocks, and so all sorts of things have been going on. And Alliance Trust has just kept kind of powering through it. And I think that's just testament to this idea of like not trying to take big bets on will oil price go up or will US interest rates come down, but trying to keep that element of it neutral and then just pick the best companies. So that's what Witan's going to get. If you're a Witan shareholder, that's what you're going to end up with. For Alliance Trust shareholders, it won't see much change. The only thing that's going to be different, Witan's got a portfolio of investment companies that Andrew Bell used to run himself. Quite interesting things, lots of things that I would have bought myself. That portfolio, because you can't just liquidate it in a hurry, you destroy an awful lot of value, it's going to come across into the Alliance Trust portfolio as is, and then it will be managed out over time. As I say, there's nothing in there that's going to be bad news for Alliance Trust shareholders, not something that you need to worry about, I think.
Okay. And I mean, you've mentioned that the dividend, as a result of the merger, there is a big dividend increase on the cards. Where is that money actually going to come from? And does it actually potentially put financial pressure on the trust going forward when it comes to increasing the dividend in future years?
So there is an uplift. I'm just showing the mechanics of this. So at the moment, Witan shareholders are getting paid about 1.51p a quarter. And Alliance Trust shareholders are getting about 6.62p a quarter. And obviously the differences are because the share prices are different. But on a sort of, if you look at it sort of on a high level basis, the Witan shareholders are getting paid a little bit more than Alliance Trust ones are. So to make sure that Witan Trust shareholders won't lose out this deal from income, they put the Alliance Trust dividend up. So that's going to go up from 6.62 to 6.79. So that's an increase, but it's not huge. It's definitely manageable. Alliance Trust already doesn't try and generate enough revenue to cover the dividend. It's not the way that the portfolio is run. So because they don't want to put any constraints on the managers picking the best stocks, they don't say they have to have a dividend. And it's not one of the things that they do. So the idea is that the dividend is funded from the total return of the company, so the income plus the capital performance of the company. And some of that then comes from capital. And the amount that comes from capital each year varies. So you've got underlying dividend growth in the portfolio anyway, if they pick the kind of stocks right. So that will help. But paying a little bit more out of capital is not going to make a huge difference in the margin. and there won't really be an issue in terms of Alliance Trust being able to do that. One of the things that it did do last year, I think, it went to the court and got some of its reserves attributed from capital to income, so they're now distributable. So it's now got resources to pay dividends, just far into the future as you can possibly imagine. Hundreds of millions of pounds worth of distributable reserves that you can use to pay those dividends with. So don't worry about the dividend being cut in the future.
Okay, well, that's good to hear. Another kind of positive result from the merger is there's going to be more assets. So Alliance is saying there's also going to be lower management fees as well. Can you just put that into some context for us? How significant do you think that reduction is, and where does it put the new trust in terms of, how it measures up against its peers?
Yeah, so it's a tiered fee. So it's a percentage on the first 2.5 billion of assets is 0.52 in the first 2.5 billion of assets, and 0.49 on the next 2.5 billion of assets, and then 0.46 on anything above that. And depending on how many people tier the cash box, we should end up with about £5 billion in the fund, and hopefully that will grow. So we might end up using all of those tiers. Compared to Alliance Trust's existing fee, and just thinking about Alliance Trust shareholders, we think that the saving is on the old fee that it had is only about £500,000 a year, £450,000 a year. So it's not enormous. But in terms of the ongoing charges ratio, which is all the costs in the year for running the fund divided by the value of the assets, they think that's going to come down from about 0.62 last year to something in the high 50s. So 0.59, 0.58, something like that. We'll just have to wait and see what that works out at the end of the year. That's not too bad. I mean, there are funds that are a lot lower than that. So some of the giant, the Scottish Mortgage I think is only 0.3 something. But you're really not worried about it. The minutiae in terms of whether it's 0.4 or 0.5 or 0.6, it doesn't add up to a huge amount of money. You're much more concerned about how well the assets are being run and what the total return on the portfolio is going to be, because you're paying, let's say, 0.6 away for the to run the fund. But if your returns are 12, it's minuscule in the context of things, and everything adds up. So people do get fixated on fees. I really try to push the message that that should not be the first thing you think of when you're looking to, should I buy this trust or that trust? But actually, because of its size, this one's not going to be too bad.
Okay, and shareholders are going to be getting the chance to vote on the deal. Are there any hints that they might not wave it through? Any signs of opposition?
Not that I've seen. I mean, there are always people that say, "Oh, I wish it would have been that trust. I wish we would have had more cash," or that sort of thing. But to me, this was the sensible option, and it's not the most left field thing. I think that's the point. It's the sort of thing that you expect them to do, and I would be extremely surprised if there's much of a vote against.
Okay, good stuff. Thanks for being with us, James.
Thank you.
So that was James Carthew from QuotedData. Now, clearly one of the big benefits of Alliance Trust merging with Witan is to bringing down the charges for investors. And these trusts are not alone in going down this road.
That's right. It seems there's a growing trend for trusts to reduce their charges, and there are multiple reasons why this is happening, as we're now able to find out. Dan caught up with Annabel Brodie-Smith from the Association of Investment Companies back in July to discuss the topic. So let's hear what she had to say.
So, Annabel, we had 18 investment trusts made fee changes in the first half of the year. When I saw that figure, I wondered, is that unusually high, or actually is that just in line with what we've seen long-term average?
Well, interestingly, that is quite high. We have to go back 5 years to 2020 in the pandemic to see 18 fee changes in the first half of the year. And I think there's a few things that tells us. One, I think, is when we've got challenging conditions, we see more fee changes. The other thing is, fee changes remain relatively high, between sort of 10 and 18 over the other years, but 18, as I said, is a 5-year high. The other thing I'm going to say is the industry trend, which I think is quite interesting, is we're seeing more and more trusts introduce tiered fees. So as the trust assets grow, the fees actually go down and investors benefit from economies of scale. And we've seen that over the last 5 years, there's a 15.6% increase in tiered fees across the industry. So more and more boards are using this structure to benefit shareholders.
Is there a good example of one that's done a tiered fee?
Oh, yeah. I can give you one that's recently done it in the last 6 months. How about Edinburgh Investment Trust, obviously big UK equity income trust. They revised their tiered fee. So their new fee, first 500 million is at 0.45% per annum. Then the next 500 million of the trust is at 0.4% per annum. And anything above that billion mark is at 0.35 per annum. So as I said, as those tiers kick in, the fees go down. And the whole idea is, as you manage a bigger trust, it needs less resources. So therefore, shareholders should benefit from that, the trust increasing in size. Interestingly, at Edinburgh Investment Trust, the board negotiated it. At the time, they also put a new management team in place. So the former managers, James Carthew and Chris Field, they no longer manage the trust. They've retired, and we've now got Imran Sattar and Emily Barnard in place. So the trust board used that opportunity to negotiate a better deal for shareholders.
Yeah, because I was just thinking, like, what's the typical sort of trigger to see changes in fees? Because I certainly see it when you get a merger of two trusts together, and they might argue that they can benefit from economy of scale, or is it actually shareholders sort of campaigning for lower fees?
Well, I think shareholders definitely an important element here. Also, boards are listening very carefully. They want to be competitive against other investment trusts, against open-ended funds, against ETF trackers when it comes to fees. So you're right to say mergers is a trigger. So, for example, we had the Henderson European Trust merge recently, and as a result of that merger, the fees came down. Another reason why perhaps fees might come down, if a trust is winding up, and it can take a number of years for investment trusts to wind up and give back the money to its shareholders. In that case, you may well reduce the fees of the company because perhaps it's leading more active management. We had an example recently, GCP Asset Backed Income cut its management fee from 0.9 to 0.75%. Some trusts actually, boards are really keen to negotiate. JLN Environmental Assets Trust in the renewable energy infrastructure sector, their chair, Ed Warner, said the board wanted the company to be as attractive as possible to existing and potential shareholders. And they negotiated with the manager Foresight to bring in a more cost-effective tiered fee structure. So I think there's shareholders, but also boards reacting to what those shareholders want.
What about competition from sort of low-cost tracker funds? Because investors have got the choice here. They can either pay a fee to get a manager to try and outperform, or they can simply track the market and get something cheap. So I wondered whether the pressure from growing popularity on ETFs is front of mind for the investment trust community.
I think it's definitely front of mind, particularly for the equity investment trusts. Absolutely, investors have got a choice. Do they go for an ETF or do they go for something that's actively managed? And clearly with that active management, the fee is going to be a bit higher. I would argue that particularly with investment trusts, there are a lot of reasons why you might go for active management. Obviously, if you're an income investor, then you've got all those income advantages. You've got an independent board there to look after your interests. And you've got a great closed-ended structure, which means it's got more ability to invest in hard-to-sell assets like property or private companies or infrastructure. There's just much more flexibility in terms of what they can invest in. But of course, this active management costs a bit more.
I know that people listening to this are going to go, oh, just tell me, who is the absolute cheapest trust on the market and how much do they charge? I mean, have you got that sort of information up your sleeve that you can share?
I do. I can even tell you the two cheapest. The cheapest trust on the market is Scottish Mortgage Trust, obviously incredibly well-known global trust, around 14 billion in size. It has an ongoing charge of 0.35%. And when you think that Scottish Mortgage can have up to 30% in unquoted companies in its portfolio, that really is extremely cost effective, an active managed company like that. The second lowest is City of London Investment Trust, very well-known UK equity income trust managed by Job Curtis, which has 58 years of consecutive dividend increases and an ongoing charge of 0.37%.
What about the most expensive? I mean, I guess if Scottish Mortgage is charging essentially so little, who's the most expensive? And they must look, I guess we can't say that they look ridiculous, but is it a case where they really have to struggle to justify charging a high rate?
Normally when something is more expensive, first of all, it's normally in a more specialist sector. It's something that needs a lot more active management. So we're talking about property, perhaps talking about private companies. We're talking about in those sorts of sectors where obviously the manager has got a lot more work to do actually managing those assets rather than, picking companies and monitoring them. The most expensive company is Regional REIT. It has an ongoing charge of 7.5%. Now, Regional REIT, as we're aware, property has had quite a tough time recently. It's 700 million of assets, invests in UK commercial property, particularly offices outside London in the regions, and it's had a lot of debt. It's actually just raised some money to repay some of that debt and deleverage the portfolio. But that probably would explain why it's on quite such a big ongoing charge. And I should say, ongoing charge, they're calculated, they're published in the annual reports and accounts. They're correct as at that date. Clearly, if circumstances change in the companies, for example, it's deleveraging, so perhaps it doesn't have, same sorts of costs, then that would have an impact on the ongoing charge. The second one is as a non-member, AIC member, it's called Life Settlement Assets, and it's 5.6%. Invests in US life insurance policies, which I would say is a pretty specialist area, one I don't know much about myself. And it has an NAV in terms of assets of only 101.2 million. So it's quite a small company. And I think that is normally the case. The more specialists, or if they're smaller, then obviously those ongoing charges can be more expensive.
What's the sort of the average across the whole investment trust universe? And is there scope for that to come down a lot more?
Okay. Well, I mean, it really depends. We've split this up for you into equity trusts and alternative trusts. So those alternatives ones are investing in like infrastructure, property, renewable energy. The average for the infrastructure alternative trust is 1.4%, whereas the average for the equity trust is 0.88%. So obviously there's quite a big difference there. And that again, the more specialist, more intense asset management needed, clearly there's higher costs. The average of these equities, I think you've also got to remember, even in the equity sectors, you will have specialist equity sectors like commodities and natural resources, or biotech and healthcare, or the country specialists, which are companies like Vietnam or Korea, where you have higher charges. So I think there is scope for that average to come down. But if you look at the more mainstream sectors like global, for example, it's got an ongoing charge of 0.48%. So I think the important thing is, averages are one thing, and it's good to see that, overall we've got charges coming down, but really focus in on the sector that you're interested in and see what the charges are and how a particular trust compares with the sector average.
And just one more question before we let you go. Where are we with performance fees? Is it common for trusts to still charge a performance fee, or has that sort of trend faded away in recent years?
Well, we still have a number of trusts charging performance fees, but it is declining, actually. If we look 5 years ago, 100 trusts paid a performance fee. That's down to 89 today. It's a decrease of 11% over 5 years. I've looked at it as a total of the industry. 29% of the industry have a performance fee in place. Its tendency to be the alternatives again, or specialist equity sectors that have performance fees. I think what we've really seen is a lot of performance fees being abolished in more mainstream equity sectors. We're really not seeing that now.
Brilliant. Well, if you go onto AIC website, you've got all these charges, don't you? Clearly.
Absolutely. All up on our website for each member company.
Yeah, excellent. Well, thank you very much, Annabel, for coming on talking about fees and stuff. So it's been brilliant to have you on. Thank you very much.
Thank you. I've really enjoyed it. Thank you.
Thank you to Annabel Brodie-Smith from the AIC for that. Now let's move on to our regular look at a popular investment trust. This week we're doing a deep dive into 3i. To tell us why this trust trades significantly higher than the value of its assets, here's Tom Sieber and Steve Frazer from Shares Magazine.
Today, we're talking about 3i, which is something of an outlier in the investment trust space, to the extent that the trust universe is often presented as being X3i. So when you're looking on websites like the one operated by the industry body Association of Investment Companies, for example, you can filter to leave 3 out. And there's a number of reasons why it stands out from the crowd. Key among them, the fact that 3i is by quite a distance the largest investment trust, if you like, and it's also a long-term constituent of the FTSE 100. I mean, there are other trusts that have and are in the FTSE 100, but it's been there for pretty much the long term. It also trades at a very significant premium to net asset value, so the underlying value of its assets minus any debt. That premium stands at 46% at the last count. And if we think about the wider trend, particularly more recently, it's been for trusts to trade at a discount. Now, to give a very quick snapshot, it's principally an investor in unquoted companies, but a very significant factor behind the premium it enjoys is the company's massive holding in retail group Action.
So, Tom, the obvious question is, so what's Action?
Yeah, no, it's a good and a fair question, Steve. So it's a Dutch discount retail chain. Well, it's headquartered in the Netherlands. It actually has stores across Europe. To put it into context, when 3i first invested back in 2011, it took a controlling stake in the business. It paid just 130 million euros for it. I suppose, in terms of giving people a picture of what the shops might look like, B&M might be a rough lookalike from the UK, albeit probably not had quite the same level of success as Action. So it sells products across categories like DIY, decorating products, clothing, garden stuff, toys, and the average price is just a few euros for those products. Today, 3i's got a 54.8% stake in Action, but its controlling stake, if you factor in holdings it's controlling on behalf of third parties, is around 85%. And just to kind of present a bit of a picture of the growth that Action's enjoyed. So in 2011, it had somewhere around 250 stores, perhaps a little more than that. Today, the total is 2,600 across 12 countries. And we mentioned that initial investment of a little over 100 million euros. It generated 11 billion euros in net sales last year. So it's enjoyed very, very impressive growth trajectory. So I think, we'll return to Action because obviously it's so important in terms of looking at 3i. But I know, Steve, you've been looking at some of the sort of longer term background of the business. So what have you unearthed there?
Yeah, thanks, Tom. It's kind of seen to be a kind of aimed at a way for private investors to access private equity. So these are privately owned businesses around the world that you can't buy shares in except through various funds that invest in these privately owned businesses. So something like Elon Musk SpaceX, for example, if you want to own SpaceX, there are a number of trusts or funds you can do that own stakes, Scottish Mortgage being one of the better known ones. So private equity has always been quite popular. One of the big question marks about them, though, is where they are in the journey. What used to happen is a private equity business would stay private for a period of time and then decide that it's reached a kind of level of maturity, or it needs capital in order to fuel its growth, in which case to catapult it forward. So it then lists on a public market in the US and Europe, FTSE 100, whatever. That is becoming a much more slower process now. We're seeing companies staying private for much longer than they did in the past. And that's a massive barrier to private investors, obviously. So they essentially miss out on these great opportunities because they're staying private for longer. So you really, it's useful to understand the sort of private equity space or funds that invest in private equity, at least, to gain access to many of these companies. But what's clearly transitioned over the decade plus that 3i has invested in Action is that by rote of its own success, Action's own success, it's just become this enormous stake. I think that in March, 3i said their top 20 holdings represented 95% of the entire portfolio. And Action was worth 69% of the top 20 stakes. So just do some quick mathematics and it comes out at about 65% of the entire 3i group portfolio is this Dutch online retailer, or on and offline retailer. Now, that to me raises an issue in terms of diversification. It still says in its sort of strategy documentation 3i that it invests in a diverse portfolio of different businesses, and that is true to an extent. But when you've got 2/3 of your assets tied up in a single story, a reasonable retail investor might ask, well, am I just buying a proxy for Action? And is that really what it says on the tin? Because that's what it's doing. So maybe there's a bit of misinformation, and I wonder if they might need to update their explanations if they're not going to do much with the Action stake.
Yeah, that's a really fair point. I think, in some sense, it's been a victim of its own success with Action. It's done so spectacularly well that obviously it's overshadowed everything else. I think the current management, so the business is led by Simon Burrows, who has been there since 2012. So he's been there for a while now. And, he did sort of transform a portfolio that was a bit of a mess, frankly, and has kind of brought a bit more focus to things. But you might say he's brought almost too much focus because, as you say, Action is now such a huge part of
sure.
3i.
But I guess it comes down to investors need to be aware of the situation, but it's just part of their decision-making process. But Simon Burrows has done an excellent job. Make no bones about it. When you look at the data, over the last 5 years, the stock has returned something like 28% on an annualized basis. So that's every year on average, about 28%. And over 10 years, so this is roughly how long he's been in situ running the show, it's about the same, 27.7 or so percent, according to Morningstar data. Now, if you think about that every year, that is way above market averages. I mean, you're looking at maybe 5-6% on average for global stock markets. So that's a staggering return. And
Yeah,
you think that
unbelievable.
Action has really been responsible for much of that return.
100%, yeah, which raises questions about the sustainability of that level of return, I suppose. I mean, at the moment, 3i is kind of on record as saying it's got no intention of selling the business. It sees it as a long-term holding. And it has been able to crystallize value from this holding here and there, partly through debt-backed payouts from Action itself. So there's one of these recently where effectively Action returned money to its holders, and as we've discussed, that a lot of that was accounted for by 3i. I mean, in terms of 3i's commitment to Action, it was notable. It reinvested some of the proceeds that it got from this debt-backed payout to increase its position in Action. So clearly, it is in there for the long term. But I guess the question is, I don't know if you've got a view on this, Steve, but we follow lots of sort of businesses in our day job, and it's rare for a business, particularly a consumer sort of facing business that perhaps doesn't have some amazing new technology, to enjoy the sort of growth trajectory Action has enjoyed indefinitely. So you've got to consider there must be a point where it makes sense for 3i and its shareholders to cash out, either I guess through an IPO or selling it to another owner.
Yeah, I mean, I think that's going to be one of its major challenges. I mean, it sounds rather complex, this kind of debt-backed capital return, and it would need more time to explain the nitty-gritty than we have here. But I mean, fundamentally, in the long term, you would expect 3i to be looking to do something, and it might be an IPO, it might be a trade sale, it might be a sale to another PE firm or something. We can't really speculate at this point in time, but I can imagine conversations going on at board level at 3i Group about how do we crystallize this. It's become such a monstrous holding in their portfolio now. It's not going to be an easy thing to sell. So hopefully with stock markets being pretty healthy at the moment, I mean, maybe that's something that will present itself opportunities over the coming few years. But as you said, I mean, they have no plans as yet to sell out. So at the moment, investors in 3i Group are very much investors in Action Group, and you have to accept that as a shareholder. And I mean, you go back to your intro. You mentioned B&M as being a sort of a comparative business, albeit much smaller. But you've also got to factor in the Amazons and the Temus and the Sheins and business like this as well, coming from China and from North America. And so Action at the moment seems to be very much focused on Europe. But over time, it will surely have to focus on Asia and the US market for further expansion. And that's going to bump heads with other businesses that are not dissimilar. And that sounds pretty cutthroat to me. And you wonder what the margins at Action currently are and what they might end up looking like in 5 years' time.
Yeah, that is certainly would bring in sort of new risk, that kind of expansion out of its what is its core territory at the moment. I mean, if it did sell Action, say, or it did IPO Action, that would turn the spotlight on the rest of the portfolio. And whilst performance hasn't been bad, the picture is a bit more mixed. So you've got some infrastructure investments, which is largely accounted for by a 30% stake in a listed vehicle called 3i Infrastructure. Now, this is an asset class which has struggled in a higher interest rate environment. So, any struggles 3i Infrastructure has had kind of largely relate to that. Other private equity holdings beyond Action have also found life a bit more tricky. So looking at the last kind of annual set of results, which ran to the end of March this year, company announced about nearly £700 million worth of value growth from performance increases, but also on the flip side, 370 million performance decreases. So the balance, was still right, but there were certainly bits of the portfolio that weren't doing quite so well. There is one business which 3i seems to be particularly excited about. It's called Royal Sanders. So it's another Dutch name. You might say the business is going double Dutch, although, sorry, I couldn't resist. Exactly. But it manufactures own brands personal care products, so things like shampoo and shower gel. And you can see why in a world where there has been a kind of a trend for people to trade down from premium brands, a business like this might thrive. And 3i recently designated it with so-called, or in inverted commas, longer-term hold status in the portfolio. Just before we kind of wrap up, I guess another question for the business, and we talked about Simon Borrows, is what happens, if he were to leave? He's obviously been pretty integral in terms of 3i's development over a little more than a decade. He's 65, so obviously chief executives quite often go on a fair bit longer.
He's got years ahead of him, Simon.
Well, yeah. Yeah, I mean, Warren Buffett would say he's got 25 years ahead of him, but he's not a million miles off retirement age. And obviously there are other reasons he might leave. Somebody might want him to run their business, given he's done a good job with 3i. So I think that's something else to consider, beyond just what does it do with Action. This is another.
It's a good point, Tom. It's a really good point, because I think and we've covered this in Shares Magazine several times. It's about whether a fund management group has a sort of a star manager who seems to be the real decision maker, or whether there's a really good team ethic and a really good support network, which obviously makes when you have a lead manager departs, it makes it so much easier to keep the strategy in place and keep the ship on an even keel. And that's something that 3i must be aware of.
I think so. And they do have a process. They have a kind of a way of looking at things. They have a discipline of trying to double shareholders' money over 5 years. They want to provide kind of mid to high teens returns to shareholders across the cycle. So they look carefully at the businesses they're investing in, and they support those businesses. I guess it's different from some private equity companies who are just looking to strip everything out and run it for cash. They have a bit more of a long-term approach, and that's obviously been reflected at Action. So there is a process there, but undoubtedly there is an element of key man risk given. I
mean, I think one of the key things, if I was a potential investor in 3i, I would go to the website and look at their portfolio, top 20 holdings portfolio. There's PDF documentation there. It's all freely accessible, just to get a sense, because I think when you talk about private equity companies, often people think in terms of very exciting AI or medical science companies, and there is definitely some of that in the portfolio, but there's quite a lot of sort of relatively old-fashioned, stodgy travel, manufacturing businesses, lots of consumer stuff. You mentioned one earlier, Tom. So to get a real full handle on the portfolio outside of Action, it's definitely worth going to their website and having a mooch.
Yeah, and their disclosure is good, and there's lots of information there. So you're right, that is a good starting point for people.
That was Tom Sieber and Steve Frazer. If you'd like to hear us discuss a particular trust on the show, drop us an email with your requests. The address is podcast@ajbell.co.uk. Now we've got time for one more segment, and it's a good one. F&C Investment Trust is not only the oldest trust on the UK market, but it's only had 3 fund managers over the past 4 decades, which is an incredibly rare level of consistency. Paul Niven has been in charge for the past 10 years, and he joins us to talk about F&C and what he's been seeing in the recent months on the market.
So, I mean, a lot of people describe F&C Investment Trust as an all-weather portfolio, but I guess it doesn't mean returns will always be positive. So how did you perform during the sort of the global stock market sell-off that we saw between mid-July, early August this year?
So as you said, to me, all weather implies that you don't lose money, or certainly you lose a small amount of capital, no matter the environment. I'd regard our proposition more as a one-stop shop, or a single solution for people who are looking for exposure to growth assets. Past 10 calendar years, we've had 2 down years for shareholders. Each of those down years has been less than 1%. So it's been a pretty strong period, I would say, in terms of consistency of positive returns. It has been a really extraordinary bull market. Our focus is very much on long-term growth in capital and income, not short-term capital preservation. But the great thing I think about investing in equities is the longer your hold period is, i.e. the longer that you hold equities, the lower the actual risk of losses, at least historically. So I think you need to be prepared for short-term volatility in order to reap positive long-term returns in growth assets, equities particularly. In terms of recent volatility, clearly it's been a relatively tumultuous period in equity markets over the summer. Our peak to trough shareholder loss, taking the very highest point of our share price to the recent low point, was about 5.5%, but that was relatively short-lived. And July shareholder returns were positive, up by more than 4%. And we have delivered positive shareholder returns since the start of July. So it's been a volatile period, but positive overall returns, I would say. And I think our balanced approach there in terms of stylistic exposure certainly helped.
I mean, the global stock market sort of recovered nearly all of those summer losses. I mean, are you sort of surprised, perhaps that we saw such a big sell-off, and also by the pace of that recovery?
A really good question. I think if one considers the reasons why the market sold off, and it was obviously very sharp and very rapid, concerns over US recession clearly came to the forefront of investors' minds based upon weak labour market data. There's also some weak manufacturing data, survey data in the US, and also some weak consumer confidence. So economic concerns, are we heading into a contraction recession in the US? Secondly, there was some concern about over-optimism on technology stocks. Artificial intelligence had valuations become somewhat overblown in that area, which has clearly been driving market returns. The third point, we had a rate rise from the Bank of Japan, only a very small rate rise, but that led to a partial unwind, at least, of what's known as the carry trade, borrowing in cheap yen and investing in other assets overseas. And that unwind of the carry trade certainly had quite a material impact. And the fourth point was arguably growth disappointment in China and a lack of policy action there. So there was a coming together of a number of concerns that led to a very violent, clearly very uncomfortable sell-off in equity markets. To your question on was I surprised? Well, actually, sell-offs of that order of magnitude are not actually that infrequent. In fact, we've had 10% plus sell-offs in the July-August period in, I think, 6 of the last 20 years. If one looks at the US and global markets, 2007, 2010, 2011, 2013, 2015. So not that unusual. 2008 was the start of a bear market, clearly. All those other instances were not, and we subsequently saw a recovery. So it's not uncommon to get these kind of short-term moves. I did not predict it, but it's not a tremendous surprise in terms of the recovery. Equally sharp in terms of the bounce back. We had Japan down by 12% or more than 12% in one day, subsequently up by 10% on the next day. So I think many of those concerns that I highlighted, particularly with regard to imminent US recession, are overdone. And there was technical moves driven in part by the unwind of the carry trade that I referenced in thin markets during the summer, which probably exacerbated the scale of the move. So it was a surprise, I guess, in terms of the timing. And certainly, as I said, we didn't predict it. However, not necessarily a surprise when one looks at just the frequency and by which one can see such sharp moves in equity markets.
Just that sort of volatility that we saw on the markets, has that sort of prompted you to think, okay, maybe we need to be a bit more prepared next time, or even more cautious, or to further reduce exposure to like mega cap tech, have more value stuff in there, or should you not sort of be making sort of reactions just based off really short-term movements in the market?
Yeah, I think again, it's an excellent question. I think I wouldn't certainly want to be regarded or perceived as complacent, and I do think that periods of volatility often beget further periods of volatility. So I would not certainly be surprised if we do see some relatively sharp moves in equity markets, two-way moves in coming months. And certainly if one considers the valuation backdrop for equities, it's hard to make the case that equities are trading cheap. In fact, most metrics, equities, particularly in the US, are trading at a relatively rich level of valuations. There are clear political risks, clear geopolitical risks. So I think that there are, it certainly would not be a surprise if we do see a further period of volatility. But our approach is looking to balance exposure within the growth assets that we have. So right now we're quite balanced between value equities and growth equities, albeit we are underweight those mega cap tech names, the Magnificent Seven, against market cap benchmarks, and have been over the course of the past year really underweight those biggest stocks in the index, which are great businesses, but are trading at relatively elevated levels of valuation. So
just as we're recording this towards the end of August, the F&C Investment Trust was trading about 8% discount to the value of its sort of underlying assets. So how does that sort of compare to history? Is that sort of quite large, or is it actually quite normal? And I was just wondering whether that discount exists because of the sort of the illiquid, unquoted holdings that you've got in your portfolio.
I think it's fair to say the discount is wider than we would like it to see, and wider than the board would like it to see. And the sector, I think, is trading as we speak around a discount of around 7%. So we're marginally wider than the sector. And I think the investment trust space in general has seen a widening in discounts. What have we done? We've stepped up buybacks, back at the pace of buybacks in response. In the first half of the year, we bought back 8.6 million shares compared to 8.3 million in the whole of 2023. We're intensifying marketing efforts to explain the benefits of investment in F&C for existing and prospective shareholders. And versus history, in terms of where we're trading in that 8% or thereabouts discount level, pre-COVID, we were actually trading a relatively narrow discount, or indeed a premium. We issued shares in 2018 and 2019. Then COVID hit in early 2020. The discount widened out. But if one actually looks at where we were trading in the first quarter of 2023, we were trading at a premium for a short period of time, around about 18 months ago. So why are we trading at 8% rather than closer to net asset value? It's frankly very, very hard to be precise and hard to be scientific on why the discount is currently trading or why we are trading where we are. It may have something to do with private markets. I did say earlier on that we have enjoyed good excess return from private market investments historically.
So your portfolio's got more than 400 holdings. I just wondered, might you potentially produce higher returns if you had fewer holdings? Because if part of your portfolio is run by third parties, you're asking those experts for ideas. Why not just take their very best ideas, just a handful rather than a sort of a bigger spread from each sort of manager that's helping you?
Sure. Again, I think it's a really interesting area to discuss. We do have a diversified portfolio of investments, and that figure you quoted does include our holdings in private markets. Our aim is, again, to provide that one-stop shop solution for shareholders seeking exposure to growth assets. So we're looking to blend together a range of diversified strategies that can add return while reducing risk. Now, each of those strategies in of themselves is relatively focused. So, for example, we've got around 25 stocks in our Japanese strategy, 50 stocks in Europe, and so on. And when you add them all together, then you end up with around the 400 names that you mentioned. For me, there's a balance to be struck between focus and diversification. There's clearly propositions which have more focused portfolios, either that are a single style portfolio or a single country portfolio, or indeed global equity solutions that are more focused. I think it's a fallacy, however, that to have a view that more focused portfolios have a higher chance of producing better returns. There's also an observation, which is true, that only a small number of stocks produce all of the returns in markets, and you should focus on those stocks. That is a double-edged sword. The more focused portfolio you have, the lower chance you have of having exposure to the really big winners. More diversified portfolios have more chance of having that exposure. But again, I think it's appropriate to have that balance. And we think that our approach is about right. We are actually looking to bring a bit more focus into the portfolio in some areas. But I do think that one should look at our results, and I do think that they speak for themselves in terms of delivering an attractive mix of capital and income for shareholders through time, and also using our risk budget effectively to deliver returns for shareholders.
Thank you to Paul Niven for sparing the time to talk to us about F&C Investment Trust.
And that's all from us this time. The regular AJ Bell Money and Markets podcast will be back later this week. And we're hoping to have one of the UK's best known fund managers on the show. You definitely don't want to miss that episode. So until then, thank you for listening, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.